In 2008, you had something close to a bubble in home real estate. 50 million people had mortgages roughly at that time out of 75 million homeowners. When that bubble burst, it hit home to probably 40% of the households in the country.
The banking crisis is creeping into mainstream media as the turmoil is now so big the media has no choice but to start talking about it. But alas, the media is full of liars who are paid to speak a certain narrative. The reality is the government has drastically failed to fix the problems of the global financial crisis. Basel III was never even implemented, and now they want to deregulate even more, allowing for a wave of banking mergers and acquisitions, further inflating the bubble while continuing to hide the true problems our economy and country is facing. So today we look at the most recent mergers and we search for the truth that lies deep underneath the hood. And having said that, happy Tuesday. Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers. Markets look unstoppable, but JP Morgan CEO Jamie Dimon sees a 30% chance of a correction. I'm far more worried than others. So it's shocking to me that one of the largest bankers is worried, and he's saying, hey, you guys need to worry about this, and why isn't anyone else worrying? It's shocking to me, again, that he's saying this. But the CEO of the world's most valuable bank and architect of the fortress balance sheet that helped JP Morgan emerge unscathed from the 2008 financial crisis believes, so in other words, you guys, he made it out of that crisis very well, according to this. Now, he believes that investors are downplaying the risk of a major market correction, one that could slash stocks by 33%. There's your warning. With stock market valuations and concentration at record highs, some high-profile tech leaders like OpenAI, as well as institutions such as Bank of England, have warned about the froth in the market and the possibility that the AI bubble may soon burst. The market isn't appropriately pricing in a risk of a downturn. Dimon says, I am far more worried about that than others. I would give it a higher probability than I think is probably priced into the market by others. So if the market's pricing in 10%, I would say it's more like 30%. So market's pricing in, according to him, 10% likelihood. He's saying a minimum it's 3 times worse. So that's how frothy and greedy the market is. The market will never indicate that there is turmoil ahead, except when it collapses. Now, the JP Morgan CEO said that it has studied other periods of market euphoria, like the dot-com crash, and found that the only way to get a sense of when a bubble is coming to an end is through high valuations. Otherwise, it's really impossible to tell the bust, he said.
I am far more worried about that than others. So if you said, I'm talking about probabilities, I would give it a higher probability than I think is probably priced in the market and by others. Yeah. So if the market's pricing in 10%, I would say it's more like 30. And I'm not saying
one-third chance of a correction.
Yeah, and I'm not saying next year. Because the timing of these things is almost impossible.
So it could be what, 6 months? Could be a year?
Could be 6 months, could be 2 years. The amount of uncertainty, and I put geopolitics in that category, fiscal spend in that category, politics in that category, the remilitarization of the world in that category, all these things cause a lot of issues that we don't know how they're going to sort out. So I say the level of uncertainty should be higher in most people's minds than what I call normal.
This is from the Federal Reserve Bank of St. Louis. They're creating a new methodology. I believe they're using AI to pick up transcripts of corporations that are talking about risk. So I don't know if it's through AI, but they're analyzing the speech patterns, and they're saying that the people right now in corporate America, it's skyrocketing as far as how much they're worried about the economy, and it's going to list various reasons. This is a very interesting report. We propose a new methodology to discover emerging corporate risk in real time by analyzing the text of quarterly earning conference calls, and they're going all the way back to 2008 to 2025. They're looking at 2-word phrases within a risk-related sentence, and they're creating a timeline of major economic events. They believe we're at risk of stagflation. Okay, so that's the conclusion, but more important, I want to show you guys the spike. Okay, so here's the percentage of risk sentences in a transcript. And remember, to the Fed, emotion's important. Expectations are important to the Fed, right? Because they don't go off of fundamentals, they go off of people's feelings, right? But look at the massive spike right here. So this is the number of risk senses. And right now, the number of risk senses exceed by far the global financial crisis and is at kind of near the peak of uncertainty during lockdowns. So think about that, okay? The uncertainty of lockdowns, remember how you felt, remember how uncertain that was. They have the same level of communication going on within their organizations as far as the warnings and concerns about different risks. The number one concern is trade uncertainty. Number two is macroeconomy. Number three is policy. And number four is financial and banking. And once again, look at the spike. So when we look at this individually for what corporations are worried about, it exceeds some of these, not all, but some of them exceed greatly both the global financial crisis here and the peak of the lockdowns, which is right here. You guys, uncertainty is skyrocketing, whether you believe it or not. And it's not just mathematically, but expectations as well. Before asking Mitch whether or not Dodd-Frank failed, I want to listen to what the Treasury Secretary is saying about what they plan on doing, which is essentially a type of bailout for the banks. At least that's what I hear. Tell me what you guys hear.
The post-crisis framework has left a trail of destruction in its wake by reinforcing the larger economic dynamics that have hollowed out the American heartland while enriching the money centers in coastal cities. To be clear, the financial crisis underscored the need for new regulations. The purpose of Dodd-Frank was to end too big to fail, but it ended up creating too small to succeed.
Can you articulate whether or not, is it Dodd-Frank, like he's suggesting, is it Dodd-Frank that failed, or is it the administration and the government that failed to enact all of the safeguards of Dodd-Frank, such as Basel III? What was the failure here?
Isn't it interesting that regardless of the federal government or the local school districts, all of which have laws to adhere to, they completely ignore the laws in favor of systemic moral hazard. And I want to go through a handful of things here. So on these videos, I never know where Travis is really going with this, but I think there's an opportunity here to tie several elements in regard to Travis's question together. So terminal failure is a document that I wrote. You can look it up on my website. It's called Terminal Failure, and it is about systemic moral hazard. It's what we've done and what you can do, and it's all outlined in that document. With regard to Jamie Dimon sitting there and professing it's priced in, that the probability could be this or the probability could be that, the reality is, on a short-term basis, the options show what the probability of anything occurring is on a short-term basis in the form of delta. So you could say an event will occur that will cause a shock, systemic shock to the system. That would be fine. The market may not pick that up. It didn't pick it up on Friday, and a lot of people that were invested in the crypto coins got wiped out. However, with that said, they were in coins when the market was already stretched, meaning they probably shouldn't have been there if they knew how to read a chart. So the probability of default of a company, or probability of default of the bonds, probability of default of the mortgages, probability of default of the certified mortgage-backed securities, CMBS market, these things are all related. And to that point, this problem of the bonds themselves, as we've seen at the school districts, is what they've done with the over leverage. That problem itself is so large, it's bigger than the government's. And therefore, ignoring the laws that the government's put in place, i.e. Dodd-Frank was there for a reason. He was right to get rid of too big to fail. They didn't do it. So what has happened since 2007? It's called the Rule of 72. Then it's called, let's print some more money. Let's go get some more leverage. Now, because of that, we're going to equity strip mom and pop in the form of their mortgages, which is what has happened at the school districts by virtue of the CADs committing fraud. And we now have a system that is too big not to fail. It's going to implode. Why? Because as I've been saying, the median household income is all that matters, nothing else. And you're seeing this all the way into godly Texas, where the outstanding fraudulent school district bond debt is in excess of $120,000 per house, yet the median value of a house is 160 grand. These people don't have this money to pay this off. The bonds are complete fraud. It will never, and I will say the word, never, underline it, put it in bold, it will never be paid off. The money does not exist. If the federal government chooses to print money, congratulations, we now have the Weimar Republic. All of these problems come right back to Travis's question. Was Dodd-Frank a failure? 100%. Not because of the Dodd-Frank law itself, but because of the fact that they didn't adhere, didn't even take the time to understand what the law was, why it existed, and what the ramifications would be if they didn't adhere to the law. So what we're now suffering as a society are the ramifications of failure to adhere to the law at multiple levels. This has got nothing to do with red, blue, white, whatever you want to call it. That's not the issue. The issue is the laws exist. The United States of America, just like Texas, is a republic. The laws exist for all people, not for, well, this is going to be the flavor of the week. We're going to put Dodd-Frank out there. Let's do a bit of propaganda. Let's see what we get out of it, and then choose to ignore it. Equity stripping is a direct result of everything we're talking about here, which is systemic moral hazard. They created it. They failed to stop it. And this is going to be a huge problem.
It is a huge, huge problem. And I hope what everyone is learning that is watching these videos is not only are those credit agencies a complete failure, right? Look at Tricolor, AA rating, they go bankrupt. So rating agencies, total frauds, in my opinion. Also enforcement agencies, total frauds. They committed 29,000 fraudulent loans, Tricolor did. So they're useless, rating agencies useless, but it's a combined effort because the media is also useless. The media refuses to tell the truth, probably again, because they are paid. They are generally a W-2 employee. If you don't say this, you will be fired. So we have to find the truth under the hood. And having said that, I want to show you guys what's happening right now. Fifth Third to buy Co-America in a $10.9 billion deal to create ninth largest U.S. bank. On Monday, Fifth Third agreed to buy regional lender Co-America in an all-stock deal valued at $10.9 billion, striking the biggest U.S. bank deal of the year that would create the nation's ninth largest lender. Now, real quick, I just so everyone's clear. They didn't even use money. They used stocks. They used stock. So they used debt. They used a debt to buy something. I mean, y'all starting to see this? The banks can print money. The banks do print money. It's different than the Federal Reserve, but they can still print money. It's called bonds. And then they take those bonds, they create a security, and they use that security as collateral to create what? More bonds. This is absolutely insane. Co-America CEO Curtis Farmer said that the administration's pro-business stance was one of the factors behind the deal's timing. So nothing to do with inflation, right? Nothing to do with any economic turmoil. And again, remember what they're talking about behind the scenes. We just saw the risk sentences skyrocketing. The shifting regulatory environment has gotten more conducive to M&A, mergers and acquisitions, and we saw windows starting to open where there might be a chance for us to consider partnering with another institution. This is interesting because it's not just them. There's many banks trying to do this right now. Co-America warmed to a deal because it saw the need to grow at a time when the competitors had already expanded through acquisitions. What changed in the last 2 years was living through the situation where the regional bank crisis as a $78 billion bank not having a large retail presence. That was hard for us during the 2023 bank crisis. I got no sympathy for them because they can create debt. They could snap their fingers and take a piece of collateral and lever that up 40 to 1. So the fact that they can't make it work and they can lever up things 40 to 1, how much money in commission are you taking? How much money in bonuses are you taking? This is absolutely insane. I expect we will see more. This is important so you guys understand what's coming right now, what's happening right now, and that it's going to accelerate right around the corner. I expect we will see more combinations amongst regional banks because we are in an environment where bank M&A or equals or near equals makes a lot of sense. Okay, the latest transaction could usher in more combinations. See what I'm saying here, guys? Especially for banks with assets up to 100 billion. Two investment banking sources said. There's a lot of merging talks going on. Other banks that have been floating as deal candidates include Zions Bancorp, Flagstar, First Horizon, East West, Popular, Western Alliance, and Webster Financial. So watch them, guys, because something's going on with those banks right now. Before First Third, PNC purchased First Bank for $4.1 billion. This deal adds steam to regional banks. And I'm just going to read a couple bullet points so you guys remember what happened. And this was last month. A deal to boost PNC's assets to near $600 billion. Triple branch network in Colorado also expands PNC's presence in fast-growing Colorado and Arizona markets. That's what they're saying. Some analysts are surprised by the transaction size. Transaction adds momentum to, and this is it, guys, to regional bank M&A. So in my eyes, this is what they're using to cover up the problem. This is the propaganda, M&A. Mitch, would you agree with what I'm saying, that M&A is potentially the next propaganda word? And are we seeing the beginning of the next wave of bank runs, whether they call it M&A or not?
No, we're seeing the beginning of the bank failures. So give or take, out of the 4,700 banks still existing, about 600 shouldn't exist, mathematically speaking. Washington Mutual, Wachovia, these went down in the last go around after the mergers had started. They started stuffing banks underneath the hood of those. Well, not too long ago, Comerica was selling houses in Detroit for $1 a house. Now, let's think this through for a second. That means they held the mortgages. That means that they, the bank, Comerica, was responsible for paying the real estate tax. Why would you sell something for $1 a house? Well, what you're really doing is you're transferring your liability to the buyer who believes that $1 is a wonderful deal. I've seen some of those houses. If you had an Uzi strapped to each hip, you would not be comfortable collecting your rent. So A, why did the bank have those mortgages to begin with? How did they get them? But you see, it's a ramification of the idea that these banks are made up of people, and these people get commissions by putting these loans together. It's the beginning, it's the underpinning, the root cause of the problem that has never gone away. It just transfers who holds the asset. And the liability associated with holding that asset is obviously going up. It also begs the question, who's behind the scenes that put this merger together, and for what purpose did they put it together? Just a couple interesting questions. The other issue is, how many Comerica branches across different states are going to be closed as a result of this merger? So remember, Dodd-Frank was the idea not to have bank closures in smaller communities. Well, did anybody bother to look at how many banks are going to close as a result of this merger? Dodd-Frank was a failure because nobody adhered to it. And yet here they are through propaganda in the press saying, hey, this is a wonderful thing. Let's merge this up. No, it's not. The bigger they get, the harder it is to see what's going on under the hood. And that is what leads to the systemic failure. This is coming sooner than anybody realizes.
Yeah, and also, Mitch, they are in such bad shape and so highly leveraged right now. If just 10% of people pulled their money out of one of these big banks, just 10% of the money, bankrupt. It would be a total failure, like Silicon Valley and everything that we saw at the beginning of 2023. It's the same thing. They don't have the money. The money's gone. It's leveraged up, and paper chasing paper is absolutely shocking. And now we're starting to see that, hey, they're paying for it. And unfortunately, that cost, some of the cost is going to be passed on to mom and pop. Now, what I really want to do is we're going to listen to a 4-minute video on Lehman Brothers. And as we're listening to this video, okay, it's a timeline of what happened to Lehman Brothers and how Lehman Brothers going down impacted the entire economy and the entire world. And again, when you're listening to this video, understand that as they're talking, they still haven't even confirmed a recession. We were well into recession before they even warned the public. The reason why we're telling you that is you guys aren't going to get warning. We're just going to go into recession, and then maybe eventually they're going to tell us. Listen to what happened, and remember Lehman Brothers.
It's really sad. It's a sad turn of events because, Lehman Brothers is an institution. It's 157 years old. And here we are, they are on the brink.
Lehman Brothers, the nation's fourth largest investment bank, is taking drastic steps to try to outrun the nation's worst financial crisis since the Depression. Lehman will sell a majority stake in its investment management division and may even consider selling the entire company. Lehman has lost $6.5 billion so far this year, and its shares have plunged more than 80%. Third quarter losses alone total $3.9 billion.
The buyers are looking at Lehman. Lehman is now desperate to sell. Whether it sells the entire company or sells some of its key assets, it looks like a full takeover and breakup is very likely.
The stock market suffered one of its worst days in years Monday. Investors reacted to a stunning reshaping of the landscape of Wall Street that took out two storied names, Lehman Brothers and Merrill Lynch. The Dow Jones Industrial Average lost more than 4%, plummeting 504 points to settle at 10,915. Monday's plunge was the sixth largest point drop ever, the worst since the September 11th terror attacks in 2001.
Well, as you know, we're working through a difficult period in our financial markets right now as we work off some of the past excesses. But the American people can remain confident in the soundness and the resilience of our financial system.
This kind of thing can't happen again. It has to, prudent lending and financial control has to be core to every investment bank in the United States.
Like everyone else, I had hoped Lehman Brothers could be saved, along with the jobs that employ more than 12,000 people who live in the New York area.
It's been craziness here at the Lehman Brothers headquarters in New York. Police have set up barricades, and there's nearly 100 reporters and cameramen all camped out here waiting for some type of answer on this wounded financial giant.
A black Monday for European stock exchanges. Investment bank Lehman Brothers insolvency is weighing heavily on Europe's big markets, Paris, London and Frankfurt. In a globalized world, the fear is that Europe's banks will also suffer and become even more reluctant to lend money.
It's important to know that the monetary, banking and treasury authorities have been acting in concert over the past several days. We worked together as recently as last night. The mechanisms are in place, central banks are alerted, there is no need to panic.
But few believe that the world economy can emerge unscathed from the quagmire, maybe one of the worst since the Great Depression of the 1930s. Some say a recession is only just around the corner.
Today, there is unprecedented turmoil in our capital markets. Nobody, including me, anticipated how the problems that started in the mortgage markets would spread to our credit markets and our banking system, and now threaten our entire financial system and our country.
Good morning. Over the past few days, we have witnessed a startling drop in the stock market, much of it driven by uncertainty and fear. This has been a deeply unsettling period for the American people. Many of our citizens have serious concerns about their retirement accounts, their investments, and their economic well-being. Here's what the American people need to know: that the United States government is acting. We will continue to act to resolve this crisis and restore stability to our markets. We're a prosperous nation with immense resources and a wide range of tools at our disposal. We're using these tools aggressively.
I hope you guys paid attention to the fact that in September of 2008, through all of that turmoil, they still did not confirm a recession. They eventually told us the recession started in December of 2007. So people were getting bamboozled. I was one of those people. And then authorities were saying, don't, that's just you. It's bad spending, right? Bad budget management. We're not in recession. Come to find out we are in recession. The problem is I already lost everything. The same thing's happening right now. They're saying recession's right around the corner. We're already in recession. They're inflating asset prices. We have a much bigger problem right now with leverage and debt bubble and fraud and greed and corruption than 2009. And they're still lying to us. And Mitch, my question to you is even with all the turmoil, they still didn't confirm the recession. Why?
They never bothered to ask mom and pop on the street, are we in a recession? I mean, it's a very simple, just ask the question. You're going to get a yes or an answer because everybody feels it. Doesn't matter what economic cycle or economic ability you have. I don't care if you're a millionaire or a person earning $70,000 a year. It's all the same problem. Millionaires spend more money, but on a percentage basis, they're in the exact same boat as a person earning $70,000 a year, a family. So it's kind of interesting that just yesterday I was cleaning up a whole bunch of files that went all the way back to 2004. And you learn so many things by looking at history. And one of the things, I have over 7,300 spreadsheets. I've analyzed thousands of business models. And what is crystal clear out of all that education is that corporate debt in excess of 30% is a no-go. And we wouldn't be in this mess if the world had simply adhered to one simple rule: don't over-debt. Well, what's also crystal clear is that nothing else matters except the ability of your customer, your guest, your resident, your tenant to be able to pay the rent or the mortgage. Everything else, over and above the fact that they can't pay, is in fact systemic moral hazard created by those who refuse to enforce the laws that are on the books. Systemic moral hazard is what we are dealing with. This is going to bring down, even though people say, well, it's only 5.1 trillion. They don't get it. This problem, even though 5.1 trillion out of the $38 trillion worth of US national debt may not seem like a lot, but this is big enough to make the tail wag the dog. This is bigger than the state governments. This is bigger than the federal government. And there is no ability whatsoever to pay these bonds off. That is the systemic moral hazard created by not adhering to the laws that are on the books.
Despicable. And that's the debauchery part. So we talk about debt and we talk about debauchery. Mitch, can you give the viewers a final thought, whatever it is you want to say, maybe about the video or maybe about what you're doing behind the scenes to abolish property taxes? What's your final thought here, Mitch?
Travis did a video with Kayla Lane yesterday, and I sent a document that's on its way over to the district attorney in Johnson County probably about 10 minutes ago in support of her testimony on this video. I want to point out that every person watching this video, Kayla is you. What we have seen across the United States is Kayla's everywhere running into the exact same problems. The pattern and practice of, as Travis just mentioned, the debauchery, ignoring the laws, the debt, ignoring the laws, compounding of the debt, that pattern and practice is everywhere. In fact, I had a phone call on Sunday from an attorney in Los Angeles who you would swear was somebody internal to what we're doing here. He had the exact same problems, and he has also filed suit on it himself. So he understood it. The point being, the pattern and practice across these central appraisal districts and these school districts is clear. The fraud that has been created by virtue of the overvaluation, subsequent overtaxation at the central appraisal districts on behalf of the school districts, which owns the central appraisal districts, is clear. Dozens of laws have been violated. The DAs are running silent. So far, I don't know exactly what the DOJ and FBI are working on. I do know they have some cases going, but I don't know what they're doing because they don't really articulate it. The point of the matter is these laws exist. If you don't adhere to them, you end up with systemic moral hazard, and that ends up equity stripping, which is a fact. This has occurred across the state of Texas. This has occurred across California. It's in Ohio. It's in New Jersey, Michigan, Illinois. It's everywhere. They simply chose to ignore the law, ignore the math, ignore uniform standards of professional appraisal practice, all in favor of crime. What these people have done are crimes and financial crimes against society. It's irrefutable. And that memo that I sent out to the DA literally says the very last sentence, what in the above isn't true? Where is your proof that anything that we have listed above, which are the crimes committed by Johnson Central Appraisal District prior board and by the Godly Independent School District, where is your proof that these crimes didn't occur? The truth is, there is no proof. Therefore, the crimes occurred. Now it's the DA time to step up. And it's going to be the same thing for all these other DAs. When you know there's problems, i.e. in Los Angeles with this attorney, he's articulated them. Point of the matter is, these all lead to systemic moral hazard. These all lead to the failure of the bonds. And when the bonds crash, the whole system comes down. There are solutions, but as far as I can see right now, it would appear that their intent is to cause the system to crash rather than admitting we effed up. There is a fix. Let's get it fixed. We can put a floor and a ceiling on this fraud. We can sustain the US dollar, but these problems are all hooked at the hip.
You know, I'm going to add also to your list of what they do to us is lie to us. So they're also lying to us. And, you know, when I step back and I'm thinking about what you're saying, it's almost as if the more bonds, the less culture. So they're replacing our culture and who we are as a people with bond debt and debauchery from mostly bankers and people with financial bias. It's super heartbreaking. And so my conclusion is, you guys, I don't even know what to say. I don't even know what to invest in, except my conclusion is invest in yourself. Don't lose your hope and hold on to your purchasing power, because things are quickly coming to the end. The whole froth, the whole just buy now is coming to an end. And I believe, as we see during most recessions, that there's going to be buying opportunities on the other side of this. So if you've been patient and you made it through, because you got to be patient and you got to make it through. And I'm barely making it through. So again, I would like to say this, guys. Invest in loving people, invest in your relationships. And having said that, Mitch, I love you, man. Thank you so much for your insight. You have no idea how many people you're helping. And I could tell you this, you're helping me, you're helping my family. I love you for that. You're an absolute patriot. You guys, once again, everything is linked in the description. I'm going to get us out of here. And if you're out there investing in real estate or you're just trying to figure things out, you guys already know we wish you luck and we hope you win.